So today we're going to talk about the work opportunity tax credit. Just out of curiosity, by a show of hands or chiming in, how many of you have heard of this credit and or have used this credit with a client?
I've heard it, but never used it.
Yeah, it's one of those kind of obscure, it's available to everyone who meets the criteria, to every employer who meets the criteria, but it does take a little bit more planning because there are steps you have to take before you actually offer employment to somebody in one of the targeted groups. So from our perspective, it takes educating our clients before they might actually qualify for the credit, before they make an offer of employment to somebody who's in a targeted group so that they know what needs to be done. So it requires a little bit more planning. This may not be a credit that comes up with you if your clients are more of that after the fact compliance client, because by the time you get to the tax filing, it's too late. In fact, by the time you get to the first day of employment, it's too late. There are things that have to be done before you even offer employment to the person. So I'm kind of excited to talk about today's topic. I'm, anytime we have a topic like this where we're digging into a specific tax credit, I feel like the material is a little dry. So I'm going to try to not be super, super boring. And also I'm going to apologize because they're actually doing construction in the unit directly above mine. And so about 15 minutes ago, they started with all the hammering and the drilling. And so y'all might have a little bit of background noise today to keep you company with me. All right, so I'm going to share my screen. Let me get on the right screen. And then we can dig into today's scintillating topic. This could be really good if you're trying to get more into like tax planning, or if you have clients for whom you do bookkeeping that includes at least some level of payroll support, because this is a credit that is affected by employment decisions. And so it's more of like payroll planning a little bit. It's a joint effort between IRS and Department of Labor because it is an employment related credit. So the DOL has some stuff to do with this credit, but then it's also managed by IRS because it's taken on actual tax forms. So it's an interesting one. Y'all should be seeing my little screen here. I'm going to keep the chat open, so feel free to pop questions or comments in the chat. Also, if you have something to add or a question during the materials, as usual, feel free to chime in. You won't throw me off my game. The construction upstairs might throw me off my game. So the same disclaimer that we give every week. This is as accurate as I know it to be as of today. We all know anything to do with tax can change at any time. And it could be that between the time when I put this slideshow together and now something has changed that I didn't pick up. So you are responsible for doing your due diligence. Y'all know the drill. So let's talk about the work opportunity tax credit. What is it? It's a federal tax credit, so not a state tax credit. It's under Code Section 51. As of right now, it's set to expire December 31st of 2025. It was extended until 2025 as part of the Consolidated Appropriations Act of 2021. It's available to employers who hire and employ individuals from certain targeted groups. Now we're going to spend some time digging into those targeted groups at a little bit of a higher level. There are a couple that I'll dig into a little bit more deeply, but then I've also got a link in the slideshow, or you can just Google work opportunity tax credit and it'll take you to the IRS FAQ where they dig a little bit deeper in. So who qualifies for this credit? It's an employer credit. So it's not the individual who gets hired. It's not the individual in the targeted group. It's the employer who hires somebody in the targeted group. So that's an important thing to mention. This isn't going to be something that you're coming across on your individual tax clients' tax returns. So as you can see, there are 10 targeted groups. We're not going to read every single word on this page, but some of the highlights are people who were incarcerated or previously convicted of a felony. They're in a targeted group. Some recipients of state assistance under the Social Security Act, veterans, that's one of the ones we're going to dig a little more deeply in because that's a pretty broad category and it's not just any veteran that qualifies. Residents in areas designated as empowerment zones or rural renewal communities, individuals referred to an employer following completion of rehab. So I think we all know what that means. Individuals whose families are recipients of supplemental nutrition assistance under the Food and Nutrition Act of 2008. Recipients of supplemental Social Security income benefits, individuals experiencing long-term employment. So there are these 10 specific groups, and then each group, if you go to the FAQs on the IRS, it's going to be typically drug rehab. Or some kind of substance abuse, right? Not necessarily drugs, could be alcohol, but some kind of substance abuse rehab. There are other types of rehabilitation programs though. So there is the potential that they could qualify even if it's not specific to a substance abuse. Here's where this credit, I think, where the opportunity gets missed. See what I did there? Opportunity tax credit. Sorry, it's so loud up there. Hopefully you can hear me. On or before, oh gosh, hopefully it's not as loud for you guys as it is for me. On or before the day that an offer of employment is made, and I highlighted that, I put it in bold and red because that's really important. On or before the day that an offer of employment is made. So this is before they're actually hired, you're making an offer of employment. The employer and the job applicant must both complete Form 8850. This is a pre-screening notice and certification request. Bunch of information, not a bunch, it's not that long of a form, has to be provided by the applicant. And then that form gets sent in. So on or before the first day an offer of employment is made, the employer and the potential employee fill out Form 8850. Then the employer has 28 calendar days from the new employee's start date to submit Form 8850. Here's to the designated local agency, blah, blah, blah. It'll be on the form. There'll be some instructions where to send this in the instructions. So whatever is the designated local agency for the state where the employee works. Now, I do want to point out, this is where some of the verbiage with the IRS stuff gets a little wonky because this is like the literal wording from the IRS site. To the designated local agency located in the state in which the business is located. But then they go on to say in parentheses where the employee works. Now we know in this day and age where the employee works and where the business is located might not be the same. And so you might have to dig a little bit more deeply depending on the circumstances. There may be some additional forms required by the Department of Labor because remember, this is a joint credit. This is jointly administered between the DOL and the IRS. And then after that designated local agency processes Form 8850, the employer will receive a certification that says, yes, this person meets the criteria to be treated as one of the 10 targeted groups. Once they receive that certification, then taxable employers file Form 5884, which is the actual work opportunity credit form. And then tax exempt employers file a different form. So it's that pre-work, it's that first step that I think a lot of this gets missed. Thinking back to when I've advised my clients or like when I'm helping them with payroll and we're talking about tax planning, a lot of my tax planning clients don't hire us for accounting work or they don't hire us for payroll assistance. And so this isn't a thing that comes up throughout the year because they're not asking us payroll related or hiring related questions. So if you have a client who, as you think through their circumstances, you think might qualify for this credit, or they might hire the types of people that would allow them to qualify, you may want to reach out to them. This could be a little planning opportunity if you're trying to dip your toes into the world of tax planning. This could be an easy way to do it for those target employers. So you got to fill out the 8850, which is the pre-screening form. That happens before the offer is even made. So you've met with, or your client, the employer has met with the person, they think they're going to offer them a position, you fill out this pre-screening form. Send it in. If certification is received, you're good to go. If it's not received, you're out of luck. Now, is the juice really worth the squeeze? Potentially, yes. So the work opportunity tax credit is 40% of the first $6,000 in wages. So it could be up to $2,400 per person, per employee. It's up to $6,000 of wages paid to an individual who is in their first year of employment with you, is certified as being a member of the targeted group, and performs at least 400 hours of services for that employer. So remember, you're doing the pre-screening stuff, you're getting the certification, you're actually filing the tax credit form when the tax returns are done. So hopefully by the time the tax return has come around, you'll know how much they've been working. So the max credit is generally $2,400 per employee, right? 40% times $6,000. And then there is a reduced rate for individuals who perform fewer than 400 hours, but at least 120 hours of services. So in addition to planning ahead, like, I think this is a credit I might want to try for, me being the employer. There's also going to be some tracking that has to happen. They have to track the number of hours that the person works for them, and that'll determine how much credit is actually taken. The work opportunity tax credit, the unused portion, so say I'm trying to get it right for 2024, whatever portion I can use in 2024, if there's any unused portion, I can carry it back 1 year and forward 20 years. So first you use it this year, then if there's an unused portion, you can carry it back 1 year, and then if there's still an unused portion, you carry it forward 20 years. An important note here is you cannot claim work opportunity tax credit for employees who are rehires. And if we think that through, that makes sense, right? Otherwise, there would be incentive to hire someone, get the credit once they hit their 400 hours, fire them, rehire them, right? Like, they don't want people double dipping like that. So that does make sense. Now, where that could be kind of a bummer is if the employer missed taking the credit the first time around, and maybe the person left of their own volition. Maybe they didn't get fired and rehired for the purposes of trying to, finagle the system. Maybe it was a true, they left and employees coming back, but unfortunately not available for rehires. So any questions so far? We're like burning through this material super quickly, so we'll have time to chat all kinds of stuff.
What if they were a contractor and then you hire them?
I don't see why that would preclude. However, they have to meet the criteria, right? So some of the targeted groups include a requirement to have been unemployed for a certain amount of time. And if they're self-employed, they're not unemployed. So as long as you're not trying to get one of the targeted groups that includes requiring a period of unemployment, then you might be okay. Great question. So again, each of those 10 targeted groups has some criteria, and I didn't want to type all of that out in a slideshow. Maybe I should have to take up a little more time, but here we are. Couple that I wanted to point out. The qualified Title IX recipient, that's TANF. So if the person received basically temporary assistance for needy families, that's TANF, for any 9 months during the 18-month period preceding the hire date, then they're in that targeted group. The qualified veteran is one I really wanted to dig into a little bit, because it's not just that they served in the armed forces. They have to have served in the armed forces, of course, and be a member of a family receiving food stamps for at least a 3-month period during the 15-month period ending on the hire date. So they had to be a veteran and have received food stamps for at least 3 months, or they have to be unemployed for periods of time totaling at least 4 weeks during the 1-year period leading up to the hire date. So they have to have experienced some unemployment, which is not uncommon necessarily for people getting out of the military. Or they were entitled to compensation for a service-connected disability and then hired not more than 1 year after discharge. That is a pretty big group of people. I mean, if you don't have a lot of clients in the armed forces, you may not realize it is not that hard to be deemed to have a service-connected disability. It's not necessarily because they had arms or legs blown off, right? It's not usually that obvious. It's your friends and family members who you look at and they're healthy or seemingly healthy, productive members of society, but they're deemed to have a service-connected disability. And so if you're hiring them within a year after being discharged or released from active duty, then they probably qualify for the work opportunity tax credit. In my area, because we're heavily military, that could be a big missed opportunity. And as I was researching for this session, I'm thinking of clients who I may have missed advising to look into this credit. And I'm already making a list of clients that I want to bring it to their attention so they can just be aware that this might be a thing they qualify for. Qualified ex-felon, a person who is hired within a year of being convicted of a felony or being released from prison for the felony. So within a year of having been convicted or within a year of being released after serving time for a felony conviction. I feel like that one's pretty common too. A lot of felons out there, and when they get out, of course, they need jobs, not always easy for them to find. And so there is incentive for employers who hire ex-felons. I will share this little presentation with Imelda, but if you want to grab a screenshot, or again, you can Google work opportunity tax credit. It'll take you to the IRS FAQ site. I think it's definitely, you know, my goal with today's session was just to make you aware that this credit exists, because I feel like, and by the show of hands we had at the beginning, I feel like a lot of people have heard of it, but not many people have taken advantage of it, and a lot of people don't understand it, including me. As I was researching for this session, like I knew generally that there was some pre-work that needed to be done beyond just filing a form with a tax return. I didn't fully understand that it even had to be before the person is hired. And so I think missing that step can end up precluding a lot of people from taking the credit who might otherwise qualify. So this can be a really, I don't know if I'll say easy, but easy tax savings opportunity to share with your clients.